Great. Okay. Now, welcome everybody. This is week 9. And what we're going to be looking at today is mainly a rather exciting area of venture capital. At least that's going to be what's going to occupy most of our time. And the whole question of how you go about raising capital. How do you get equity? How do companies get started? Companies are legal persons. They are like you and me in that they have to stand before the courts. They have to follow the law. They can make money. They can save money. They can do all sorts of stuff. I even heard of one company being charged with murder. Apparently, I can't remember, it was one of the American car companies. And apparently there was evidence that their management had allowed a dangerously defective something or other in one of their cars to go out and get sold because it was cheaper than fixing it. And somebody died. And so there you go. I don't know who it was, but it was one of those companies. So that's what a company is. A company is unlike a person, though, because it doesn't die. And that actually causes all sorts of long-term complications, shall we say. In the 1800s, when people were discussing the idea of limited liability companies, the form that we have today, there was a lot of concern about this, because one of the advantages in the normal world is that if you have some bad dude turn up, they're only on the planet for a certain amount of time, and at worst their children might turn up and replace them and create a bit of a dynasty, but by and large it doesn't go on forever. Whereas with corporations, the whole question was what happens to something that is as illegally as much a person as you and me, but just goes on forever. And that was really an interesting debate. And at some point, if you're interested in finance and if you like the implications of finance, it's actually probably a good idea to actually go into that history. One of the outcomes was the observation, this was back in the, about 150 years ago, or a little bit more, the observation that because companies never naturally died, their trajectory would either be growth or absorption into other companies. Companies can fail, and so they can kind of die in a sort of way. But more likely, if they've got something useful kind of happening with what they're doing, they will either grow, and if they grow, they will either absorb other companies or they will be absorbed by other companies. And this is one of the curious things. When you look around today, I live in the Sydney region, and there are shops and companies. There used to be a fairly large office building devoted to a transport company called TNT. Probably still operating. I just don't happen to go that part of Sydney anymore. Great big letters, TNT, Thomas National Transport. And the curious thing about that is that very big organisation started off as a gentleman with the name of Thomas who had a truck. A normal flesh and blood person, just like you and me. He started off by himself as a normal flesh and blood person, just as a sole trader with his truck. And the same can be said for companies with names like David Jones, or Grace Brothers, or Myer, and a large number of others. They started off as people. Then they got bigger, eventually became public companies, and, well, now we see them. Some companies start off as companies, but a lot of them actually sort of just grow out of very small businesses. What we want to look today is how that process is done and what things we need to take into account when we're considering the way that companies come into existence. The first thing about a company is that all companies are businesses, and all businesses exist to supply some good or service to the community that the community is willing to pay for, so that the people running the company, the owners of the company, end up earning an income. That's as simple as it gets. We kind of tend to lose that as companies get bigger. We still identify Microsoft with Bill Gates, but maybe in 50 years' time, people won't. When you think about going down to shop at David Jones, you don't think of some benign old gentleman coming out and seeing how his staff are caring for you with the name of David Jones. Somehow there's this transition that kind of happens. And the company, as it gets bigger, sort of changes its whole character. But ultimately, or originally, every company, every firm, every business exists to do something useful for other people, and with the anticipation that by doing that useful, sometimes innovative thing, the community will reward that individual, that entrepreneur, that business, whatever you want to call it, with economic rewards, payments, profits. And to the extent that the businessman, the owner, the people working in that firm are able to flourish. That's kind of, if you like, the social foundations of it. We kind of lose sight of that when, you know, we're dealing with Amazon or, you know, Telstra or something, because, you know, it's easy to lose sight of that. But I think in approaching this topic, it's kind of useful if we do. What happens then, though? Somebody has a good idea. Mr. Thomas has his truck. He's a good truck driver, punctual, courteous. He cares for his load, cares for his customers, and as a result, he becomes very popular. And therefore, or as a result, he becomes successful. Same with the founder of Domino's Pizzas or McDonald's Hamburgers or good old Colonel Sanders, as much as he sort of tends to have gone into eclipse in recent times. So they all start off with somebody doing something which is a good idea, able to provide something of use to the community, a good idea. And that good idea is, you know, warrants a reasonable return. As the company gets bigger, though, it goes from just that individual level to the point where it needs to expand. And therefore, it needs more capital, maybe more machines, more factories, more computers, the capacity to employ more people, and so on. And so it goes through this transition, you know, from the sole trader or maybe the partnership up into some sort of corporate kind of form, and then ultimately a public listed company. We're going to be looking primarily at that process today. Okay. How business gets started? Most businesses get started by an entrepreneur, a good idea being championed by somebody who's got the vim and vigor to actually to promote it. At that point, the idea is quite profitable. But there's a major trick in all this, that you can't just have a profitable idea. You have to have a profitable idea that is able to be organized into some business arrangement where it turns into sustainable revenue, profit patterns and whatever. And so you need not just the technical idea, you also need the business nous to be able to sort of put those two together. Now these days, unfortunately, we tend to concentrate probably too much on the business nous side, and not quite so much emphasis is on the technical side. One of the curious things about Bill Gates, I'm told, actually one of his classmates from university, that he has never sold a program that he wrote. He went to, I think, Harvard University, studied computer engineering, and so he knows how to do computers, but he never actually sold any of his own work. He was more of an entrepreneur than a computer programmer. And to a certain extent, if you're a really good computer programmer, people will give you all sorts of disparaging titles like nerd, and you'll end up being stuck in the back room and you're being considered very boring and all the rest of it. And sometimes people are comfortable with that. And if you're a nerd who does something sufficiently important, you get paid, you might be very happy sitting in the back room and all the rest of it. But it's the other folks that sort of take the front line, the entrepreneurs, that tend to get the show started and, you know, tend to do the other. And so somehow the world seems to need these, you know, the bushranger type sort of entrepreneur connected to the technical savvy, nerdy type. We seem to have done a bit of a change in our culture. Coming out of the Second World War, which is now about 80 years ago, we tended to think, just excuse me for a moment, excuse me, not COVID. We tended to look more at the technical side of innovation. And so soldiers coming back from the Second World War, let's say in 1945, were looking at becoming engineers, scientists, mathematicians, going into that line of work. And for the 10 or 20 years following the Second World War, Australia produced an enormous number of really, really clever engineers and scientists. And in fact, we were leading the world in terms of innovation. There are many things that we take for granted. Things as humble now as photocopying machines and really sort of laser printers. Australian invention. Penicillin, an Australian invention. At one stage, Australia housed the most advanced computer in the world. It was at Sydney University. There are many other places where we had this emphasis on the technical side, and somehow the people were able to thrive and, you know, do comfortably, and Australia sort of came ahead. That was all really good. Now we tend to get our biggest or best and brightest to study finance, which is what you guys are doing, which sort of says probably you're the best and brightest in the community, because you've worked out you make more money being a finance controller than actually sort of sitting in the back room doing computer programming or something like that. Okay. We need the entrepreneurs. You've got to get that balance right. The entrepreneur is going to flesh out their ideas and turn a concept into a practical business strategy. That's important. Usually when a good idea gets started, the funding, the capital that the company needs is supplied what I'll call informally. Often it might be some idea that somebody puts together in their garage, using their spare time and maybe their personal savings. If their business starts to take off, they might enlist the support of people they know, their friends and family, to maybe get a bit more savings. They might be able to even get a little bit of money from the bank. And the company then goes to this next level of operation. Okay, we refer to that initial capital, which can be almost negligible. The capital, the assets that's used, could be as simple as the tools that are lying in your garage, or the computer that, you know, one day you're playing video games on and the next day you're designing some accounting software or financial analysis package or something which you're going to, you know, it's going to make you a millionaire. So the capital can be quite modest. As your business grows, though, you get to a point where you need more than what that informal financing can supply. But by that stage, your idea is starting to show promise. You might have built some prototype in your backyard or in your garage, and you might have sold a few of them, and you're able to then say, well, I've got a nice little business here, but I'm a bit limited because I don't have the time and I don't have the money to really sort of take this to the next level. At that stage, you run out of that informal financing. We refer to that informal financing as seed money. These days, we consciously allocate seed money, but it comes to a point where it's not sufficient. At that point, you go out looking for somebody who has an interest in backing new ideas and new businesses. And especially to take them from the idea of a small business, which might have certain limitations, to the point where it's a solid business with promise towards expansion and so on. At this point, we move away from our personal connections, and we might go looking for somebody who's got a bit of wealth behind them, or maybe an organization that specializes in this sort of thing, but is willing to take the risk of backing a good idea, a good business idea. We call those people venture capitalists. And if you're serious about starting some new good business, it'll probably be a couple of years in the incubation stage when you're doing the informal seed funding approach and the informal, building things in your garage, or maybe selling things out of, a stock that you keep in your living room. I recently visited a chap who only lives probably about 15 minutes from where I live, and he sells maps. These days with Google Maps, nobody bothers a great deal with paper maps. Well, at least most people don't bother. But there's still a little bit of interest in paper maps. And I wanted a paper map because I wanted to do a bit of, I was doing a bit of research, a bit of property consulting. And I wanted a paper map to be able to go onto a bit of rural property and put it into context and so on. So sell out. Well, he had a business which looked as though it was actually looking after him very, very well. And it looked for all the world like he started off with a 2-car garage, and now his cars just live on the driveway. And he's selling maps all over Australia. And when I went in, it looked very sophisticated what he was doing. Now, does he want to go any further? I don't think this particular chap does, and he knows that his market is limited. But if you're doing something that has the capacity to sort of scale up and become even more successful, you want to find somebody who is able to give you a lot more money and maybe a lot more assistance in the entrepreneurial area to help manage your company and give it the kind of formation, the business discipline, if you like, to be able to really flourish. And so the little company operating on its informal funding, its seed funding, will then go and look for a venture capitalist. A venture capitalist is an investor, but they're not your typical investor. Most of the time when we think about investors, we think about people who are looking at capital asset pricing models and not wanting to risk too much, and maybe investing in portfolios of different stocks to minimize their risk. And it's all minimize the risk, minimize the risk, minimize the risk. And as a result of that, the average investor is said to be risk adverse. And because they're risk adverse, they prefer to earn a smaller profit on a sure thing than a huge profit on something which is pretty risky. Venture capitalists are not your typical investors. They look like actually gamblers, because they come in and they will maybe consider 10 projects, and they might expect only 1 or 2 of them to actually succeed to the point where they're profitable public companies, and they know that the other 8 will just stand dead in the water or maybe worse. But they're willing to put money into all of those because they want to make enough money out of the 1 or 2 out of 10 that flourish to be able to offset their losses out of the other 9 or 10. And so they're risk seekers. Doesn't mean they're stupid risk seekers. It just means that they go for the risky end of the market. Probably in the same way that people that bet on horse races are not naively gambling. Often they'll use as much science as they can to understand the form, to get an idea of the quality of the horses and the riders and the track and all sorts of things, to try and work out where the tiny mathematical edge is that will actually cause them to bring home more from the racetrack than they take in. And so the venture capitalists are a bit like that. They're sort of the cowboys, the gamblers in the market. In recent times, venture capitalists have developed a kind of a charisma because we've had a lot of new companies starting up in the internet kind of age. And the internet has proven to be a wonderful platform for young creative thinkers. And so things like Facebook is now a bit passé, YouTube, WhatsApp, Twitter, all of these have started off as the idea primarily of individuals. They've ended up becoming fabulously productive, important, profitable, and they've sort of turned into something else. And along the way, each one of those would have been looking for venture capitalists to take a punt on the investment. So really what I've done there is described why venture capital funding is different, because they're risk seekers and they're actually looking to be involved in the business in a particular part of its age. They don't want to start things from just an idea that somebody talks about over a beer or two on a Friday night. They want to be more developed than that. But they don't want it to be so developed that it's like BHP or AMP Society or, I don't know, Ford Motor Company, that has been around for so long and is such a proven performer that people consider it as a nice, safe investment, and they don't expect a huge rate of return from it because it is so established and so reliable. Right? The venture capitalists kind of operate kind of within this gap where something is going from, you know, maybe a couple of computer programmers in their back room, like Bill Gates and his mates, to in this gap between when it goes from the back room, living room kind of business up to the multinational. The venture capitalists want to come in this middle where it's growing from one end to the other. One other point which I think is useful to know, you don't find it so much in the textbooks, but I think it's useful to understand, is that as companies get bigger, they become less profitable. That often surprises people because people think Microsoft has become more profitable as it's got bigger. You're 100% right, to the extent the number of dollars of profit that Microsoft are producing each year is increasing. However, compared to the size of the company, both in terms of human resources, physical resources, and capital, Microsoft Corporation is less productive than it was when it was just a couple of blokes sitting in a living room doing software and trying to flog it to people. And you find that fairly typically. If you go off and start some new food fad, maybe discover some way of, I don't know, cooking cane toads, which becomes fabulously popular if you're in Queensland, and you're able to make a good business as the cane toad restaurant, that will be a far more profitable venture than when it's bought out by some chain of restaurants or something. It'll still be profitable, but the bigger the organization gets, it tends to become less profitable. And that's one of the curiosities. It's almost inescapable. And the reason for that is that regardless of all the business nous and resources that you put into marketing and high-powered executives and all the rest of it, the fact is that larger companies have a lot more overhead and their operation tends to be a lot more administratively focused than production focused. And so, you know, they basically get sort of bogged down by their own administrative superstructure. Okay, we're getting ourselves a little bit in front of ourselves here. Okay, there are a number of issues here to consider when we're looking at what the venture capitalist brings to the table. They are risk seekers and they have money and they're willing to invest it in risky ventures so long as they provide the promise of being very profitable. In recent times, they tend to be associated more with the software industry because that seems to be where most of the innovation is coming from and most of the opportunities are. That hasn't always been the case, but for that matter, the idea of identifying, you know, a species of creature on the earth as a venture capitalist is also relatively recent. The third point here is that they're using very fancy terms, informational asymmetry. All that means is that there is a difference in who knows what within the relationship between the businessman who's starting the show, maybe the entrepreneurial people he's got associated with him, and the venture capitalist. The venture capitalist is more likely to have a stronger understanding of how to make a business work and how to make it grow. So there's an imbalance there. Because their client, the company that they're buying and building up, won't have that skill. And so the little company is looking to the venture capitalist to say, how do we do this stuff? How do we turn into a Microsoft? On the other hand, the little business has got a far stronger idea of what is going to be the innovation. They've usually got the technical skills. They've got the creativity, the inventiveness that the venture capitalist doesn't bother to have. The venture capitalist got the money. They don't have the technical skills. And so the company has this strength in terms of their technical understanding. The venture capitalist has the strength in terms of the entrepreneurial understanding. Okay, I like this graphic. I'm going to blow it up a bit, make it a bit easier to see, especially when these notes get onto YouTube. This is really important. What we're looking at is time or growth, and we're looking at the size of the company measured in terms of sales. When you've got the little company operating out of your garage or out of your lounge room, financing is fairly informal, your sales level is negligible. When you're starting to make it look like a business, you'll either have seed funding in here, which will be enabling you to make a quid and turn a hobby into a business. But then at some point you say, hey, we want to take this further. And this is where venture capital comes in. Venture capital will take your sales from just a little part-time hobby kind of business and raise it up to the point where it's looking like a mature company. And that's a really significant growth in sales levels. And so this has been broken up in this schema to look at three parts of the venture capital life expectancy, if you like. You've got the beginning part where they're just getting the thing off the road. You've got the exciting part through here where the company is really starting to take off. And so the business is up and running and growing and really making a name for itself. Down here, it might be only the people in the street who know that it exists. By the time you get up to this point, it might be something which is statewide or perhaps even national. Maybe not at this level, probably more further on here. The venture capitalist, though, wants to be out somewhere in this phase here. Because the venture capitalist eventually wants to be able to sell their interest, their shares in the company, to the world in general, to other shareholders, to your typical risk-adverse shareholders. Because the risk-adverse shareholders are people that are looking for a nice, stable, reliable company, which the venture capital is actually building. And the risk-adverse investors are expecting to only have a relatively small yield, a low level of profit for their assets. Whereas the venture capitalist wants a high level of yield. So for every dollar the venture capitalist puts in, they want a very strong return because it's risky. Up here, when you get to the general public, they want something we're not going to lose their money on, and so they're willing to accept a lower rate of profit. Now, if you think in terms of the dividends coming through the company, as your sales are going up, your dividends are going to be going up. Now, if you take either side of this point here, on one side you've got the venture capitalist owning it. Those dividends are going to be coming out of the company regardless of what the company is worth. But if the venture capitalist is looking for a return, let's say in the vicinity of 15, 20, 25%, That means that the value of that investment to the venture capitalist is relatively small, because for every dollar that it produces, the venture capitalists might want a 20% return. And so it means that for every dollar of dividend, the venture capitalist is only willing to pay $5 or put $5 into the company. However, if you come over to this side of this divide, where it's being sold into the public, so imagine the public is happy to earn, especially in at this part of history, like this year or the last few years. The general public is probably happy with a 5 to 10% return. Look at what this does to the amount of capital that the company is able to access. Here, every dollar of dividend the company is able to produce enables the venture capitalist, or inclines the venture capitalist, to subscribe, what do we say, $5 towards capital, $5 towards the machines, $5 towards the plant and machinery, $5 towards the computers or the real estate. But once they sell it to this risk-adverse investor, that $1 of dividend is then going to only need to perform at a yield of about 5 or 10%. What does that mean? For every dollar of dividend, the risk-adverse investor is willing to invest something like $10 to $20. Here, a dollar of dividend will cause an investor to put up $5 or $10. Here, the same dollar of dividend, just on the other side of this little threshold here, is able to attract somewhere between, what we say, $10 and $20. So there's a sort of like a doubling in the access to capital here, because you're appealing to a different type of an investor. And by the time you get into the public here, the public generally are happy with a lower rate of return, because they want that backed up with lower risk. So this is a very important graph. And it's worth just having some time to think about it. Now, the venture capitalists, while they are risk seekers, they're not stupid. They want their 20% return, but they don't want it so that every 2 or 3 years they end up with, a major loss or whatever. They want to reduce their risk as much as possible, even though they're generally happy to take on activities, projects that are more risky. And so the venture capitalists are very conscious about reducing their risk, right? There's nothing better than betting on a sure thing. What are some of the things that they do? One is, rather than saying, oh, you need $10 million, well, here's $10 million, I'll say, you need $10 million, and I'll give you $1 million in the next 6 months, and I'll give you another $3 million in the 6 months after that. And then I might give you another $5 million in the 6 months after that, assuming that everything's going well. And then I might give you what's left over, $1 million right at the end, and you got your 10 mil, and away you go. And that way, by staging their funding, they're able to see how you're going. Are you able to make good use of the first $1 million they give you? Yes? Good. Fantastic. We'll give you $3 million. Are you able to make use of the $3 million plus the original $1 million? You're going along, and yes, okay, that's good. Fantastic. Okay, so you're using your $3 million well, $4 million. And so they give you another 5, and so by this stage you've got 9 million that the investor. Now, why do they get the 5 million? Because it's staged. It's only coming in bit by bit as the entrepreneur, as the company is able to use it, and as the company is able to show that they can responsibly use it. So stage funding is very important. Personal investments, that can be in the form of hurt money to a certain extent. Still maintaining the personal input of the people involved in the venture itself. So you don't just come along and get the venture capitalist to supply all the funds. You've got to show that you're willing to, I don't know, put your house on the line or whatever it takes, that you've got a dog in the fight, so to speak. You've got a personal interest in performing as well. Venture capitalists like to see that. If you or I were to go along and say, yes, well, we'll invest sort of, $50 or something, and we'd like you to invest 10 million, the venture capitalist would say, oh, well, it looks like if this goes sour, we lose 10 mil and you lose $10, or whatever it is, $50, $100. I don't think it's going to hurt you nearly enough to keep you on your game. Okay, syndication. Syndication is a very practical approach. You might have a wonderful idea that you think is going to transform the world and make everyone who's associated with it really wealthy. The venture capital might be able to fund that, but they know that for every 8 that they, or every 10 that they fund, only 1 or 2 of them kind of get up. Every 10 that they fund, maybe 1 or 2 of them get up. And so they will be motivated not to take the whole thing on themselves, but rather go along to maybe some of their venture capitalist mates and say, well, instead of, let's say we've got 10 venture capitalists, and if each one simply took on 1 project, one of the things that you'll probably expect is that at the end of the day, 8 out of 10 of those venture capitalists will have done their money, because that's just the way that it goes. Whereas if those 10 venture capitalists get together and say, well, let's take a 10% interest in these 10 projects, the 2 that actually do so well that they pay back for any losses and overcome any exposures that the venture capitalists have. And all of the venture capitalists go off sort of smiling because they've all had some kind of a part in the pie of a successful new venture. So syndication is very, very important. Last one is in-depth knowledge. Now, I've already talked about informational asymmetry. That in-depth knowledge is where it's an advantage for the venture capitalists to have a very thorough understanding of what they're backing. Very thorough business understanding, very thorough technical understanding. And they can rely on the in-depth knowledge partly from the people that are putting the idea up, but it's also an advantage if the venture capitalist has some familiarity, at least a general familiarity with the general dynamics of what's being presented. So you'll find that some venture capitalists will specialize in, let's say, mining ventures. Other venture capitalists will specialize in software ventures. Some will specialize in perhaps health-related or whatever, because they can then know those industries and the potentials in them a lot better. And so it simply helps to manage their exposure to risk. Okay, I don't think we need to talk about that because I've already done that. Personal investment. And this is where they'll often require the entrepreneur to make a substantial personal investment. That's exactly what I've kind of laid out. And I think we've done all that. Okay. I've mentioned that the venture capitalist doesn't intend to have a long-term involvement in the investment. They're only looking at it for that period when the investment is being, or the business is being transformed from a little business to a big business. And so they are going to want to have a way of getting out, of on selling it to the people that would prefer to buy a bigger, more stable, more reliable, lower risk kind of company. Okay, exit strategy is what we're talking about. Because of that, the venture capitalists will often go in very explicit about when they are going to leave. When your sales reach such and such. In 5 years' time, we're going to be looking at, reviewing our involvement, whatever it is, the timing. Also, the venture capitalist doesn't want to simply shut the door too abruptly. And so the method of exit is very, very important, how you kind of hand over to the next level. And the last thing is, what is the acceptable price? What total return does the venture capitalist expect? And so that's often sort of worked out, often negotiated beforehand. Often the venture capitalist will be spending a certain amount of energy finding buyers for the business once they're ready to pass it on. There are three possibilities for buyers. They can, buyers can be simply general investors who wake up one morning, discover there's a new company listed on the stock exchange and go down and buy some shares. But it's more likely, especially these days, for a new company to be largely bought by a holding company that has decided that the new company is worth investing in. And so this will, you know, if you sell 1 million shares, notionally you could be selling them potentially to 1 million different people. But that's awkward and expensive. It's easier to sell it, that 1 million shares, to maybe, you know, either a wealthy individual or a company that specializes in buying investments, a holding company. A holding company is just a company that holds other companies. If you're selling to something like that, let's say to the holding company situation, you only have to really sell to one person. It's a lot easier to sell a whole lot of stuff to one person than it is to sell a little tiny bit of stuff to a lot of people. Simply getting around to seeing them is difficult. There are two types of investors that are likely to buy from a venture capitalist. Before we get on to those, probably important just to note that the venture capitalist buys the company when it's a company, but not a public company, or at least usually not a public company. The venture capitalist sells the company as it transitions from being a private company to a public company, public listing company. Okay. In amongst the large investors that are likely to buy fresh new companies, we can identify two different types of buyers. The first we will call strategic buyer. A strategic buyer is somebody who looks at some new company coming on the scene and they say, oh, that's useful for our expansion. Remember right at the outset I said the two main things that happen to companies is that they either grow or they get absorbed by other companies. A strategic buyer is in the business of buying smaller companies to make their whole show work better. If you open up the Google homepage on Chrome, you'll see there's a little box with all the different services you can get from Google. Well, it turns out that Google didn't write most of those services. Most of them were other software facilities, online software facilities, that one by one Google has bought. And the advantage to Google is that every one of those extra little icons that goes on, extra tool or game or novelty that sort of goes on, is actually increasing the strength of the Google company. And so the strategic buyer is someone like Google buying up WhatsApp or Zoom, Amazon, whatever. Strategic buyer is looking to make their organization stronger by buying up these small ones. Remember, the small ones tend to be the more profitable, at least in terms of yield. Okay, there's another type of buyer which is not a strategic buyer, but it's also often a large buyer, or at least a buyer with deep pockets, and that's a financial buyer. Financial buyer is an investment company, a holding company, a company that likes to hold shares in other companies, and it does it merely because it knows that those other companies are making a nice profit, and by the holding company holding those shares, they're able to provide a good return to their shareholders. And so holding companies are curious things because they're not really doing what companies are meant to do. They simply act as a kind of an intermediary between the companies who are actually doing stuff and the investors. Financial buyers, when they're looking at young companies, are the type of financial investor, financial buyer, who sees that young companies are often more profitable than older, more accepted companies. So it's not a venture capitalist, because they're not operating that very high risk of very high return, but they're almost the next stage where they see the opportunities of a young company to be profitable in the longer term. They're not venture capitalists because they want it to be sort of proven to a certain extent, but they are hoping for a better return than it would sort of come if they just bought what I'd call, the most reliable companies, the blue chip companies. Okay. Sometimes, if a venture capitalist can identify either strategic buyers or financial buyers, the venture capitalist will hardly go to the stock market at all to sell the shares. They'll sell them in large parcels to strategic buyers and financial buyers. However, if it's not considered that there are going to be either of those two categories, the entrepreneur with his venture capitalist mate will look at making an initial public offering. A public offering, so it means that they're offering the shares to the public as a public company, public listed company. It's an initial public offering because it's the point where the company just begins to be a public company. And so the initial public offering is the process by which this first package of shares, usually most of the equity in the company, is all converted into shares, and they might sort of sell some more to get some more capital to be able to do a bit of growing and so on. And they'll be selling them to the general investors, no one in particular. But to do that, you need to have a marketing sort of skill, because the mum and dad investors may not know about your new company, hoverboard manufacturers or something, and so you need somebody in the work of the venture capitalist to actually form that public offering up, so that when the balloon goes up, when they are listed for the first time on the stock exchange, it's actually possible for people to know about them, have a bit of an appetite for them, and so on. When we talk about a stock exchange, most of the stock exchange is what we call a secondary market. The primary market is the initial offering market. It's where the company sells shares to the owners, to the shareholders, to the investors, whatever you want to call them. And so the primary market is BHP selling a BHP share to you or me. The secondary market is when we take our BHP share and we sell it to one of our mates, or I don't know, give it to our mother-in-law for Christmas or something. Now, the initial public offering is tricky, because whereas the secondary market, going in and buying shares in BHP or what have you, is pretty easy and straightforward, the primary market is really trying to sell a new product, a new idea, a new good. And so it has to be managed carefully, has to be promoted thoroughly, and it has to be done in such a way that when the dust settles on this initial event, this initial listing event, enough of the shares have been sold that the company then can work as a public listed company. It can't do that if no shares have been sold, because that could very well mean that the company still has really none of the financial resources to be able to operate. And so if this is done badly, a company which has started off as a fabulous idea, it's kind of grown through seed money and then the venture capital, and it's now sort of humming along as a pretty solid kind of business making, profit-making business. If the IPO is not done properly, and the company sort of finds it doesn't have the capital it needs, that could be the end of the company. So this is kind of high-risk stuff. Okay, I think I've mentioned already that venture capitalists will contribute advice, mentoring, management, and maybe even explicit controls on the company. And especially if the venture capitalist is related in some way to the industry, you know, if they're specializing in software or specializing in infrastructure or whatever they're specializing in, that's something that they can bring to the table to make sure that what they do invest in has got a higher probability of success. Really important. Excuse me. Okay, this should be pretty obvious. Cost of venture capital is very high because they're expecting high rates of return, and numbers like 10 to 20% on the money that invests, not uncommon, and sometimes more. And we've got the data which suggests that, in general, the average return for venture capitalist companies, capital companies, is about 12%. So it's really quite high, considering what the typical return from the stock exchange is. I mean, now with Corona, it's probably gone down the tube. But, you know, in a good year, you're probably looking, like in the current environment, probably, you know, 5, 6, maybe 7% if you're doing really, really well. But most of the time, general market averages out in the middle of the, you know, the 5, 6 kind of area. Sometimes a little bit higher, sometimes a bit lower. Okay. Right, we're moving into talking about the initial public offering, IPO. Lovely expression to go and tell your friends with when you're next to a party or something. If you're able to go to a party, I hope you're not living in Victoria at the moment. We introduced the idea of the IPO, so I think what I haven't spoken about on this slide, you'll be able to read quite easily anyway. The advantages of initial public offering is that it means that you're selling to a far wider market, and so that means you don't have the responsibility of actually, you know, having to find every investor that you need. You simply just, you know, put the sign out and let them come and take them. It's a major one. Let's look at some of the advantages and disadvantages. We're doing an IPO because we want to get more capital. We want to grow our business. And I think I've explained this first point. Done prudently, as you sell your ordinary shares, you're also selling control of the company. You know, you've got the single person operating out of their garage, they've got pretty much total control of the company. By the time the company is owned by, you know, 20,000 investors, some big, some little, then it becomes a little bit more difficult. And there's a fair bit, and a bit of it's kind of covered in the textbook and it's worth reading, about just the strategy, the strategic thinking that needs to go behind that. When you do the IPO, what are you going to do to make sure that one of your competition doesn't sort of buy up enough of your shares to be able to make life awkward for you, or maybe buy up the shares with the intention of having you absorbed into their company when you're not looking. A number of things like that. So you can kind of read through that issue. The issue of control is really, really important in public companies because shareholders act as a democratic body, and it's not one person, one vote, it's sort of one share, one vote. So if you own 20 or 30% of the shares in the company, then you're going to have a lot of control over it. We talked about the next one, secondary market. This is just almost a psychological fact. Once a company has grown to the point where it's a public company, it's going to generally find itself easier to find the more effective management. There's some mysterious thing about effective managers. Some of the things about effective management you cannot learn at university, simply because they've got to do with, you know, personality traits, almost psychological issues that are very individual. In some cases, you're born with it rather than can learn it. Sometimes you can screw yourself up as you go. Okay. Disadvantages. An IPO done properly, largely because of the marketing and a certain extent the compliance requirements and all the rest of it, they're very expensive. you've got to really push this this whole process, and that can sort of eat into your capital. We talked about compliance costs. So ASIC is gives you the public oversight, and that costs a certain amount. The other curious thing, this is a little bit of a tricky one, is that once you go from managers being owners to managers being, agents of the shareholders, you change the dynamics of what motivates your senior people. That often, for a number of reasons we don't need to go into too far here, when you have IPO leading to the company being public, the managers start to perceive the objectives as short-term profits rather than really looking to the long term. Now, as I say, there's a lot of reasons for this that aren't so obvious at first, and if you read the textbook and just give some thought to it, we can talk about it later in questions if you like. Okay, the IPO is usually where there's a handover from the venture capitalists to the investing community. Venture capitalists, high risk, high return. The investing community is low risk, low return. But to connect the two, often a company will use an intermediary that is motivated by higher likelihood of return, accepts the higher rate of risk, and for whatever reason sort of says, well, that's still a good space to work in. They're not venture capitalists, and they're not the final investors. What they are is people who help the venture capitalists take the shares in the company to market, basically. Usually, these will be investment bankers, can be other organizations. The investment bankers are, well, especially those investment bankers that have expertise in the area of floating new companies. And this is a fairly specialized area. Some investment banks are better than others. And so if you find yourself in this situation, it's good not to just jump into your local bank because your son plays soccer with his son or something. Okay. Investment bankers provide three basic services when bringing securities market. Now, notice these because these actually kind of overlap with what the venture capitalist does. Okay, the three processes: origination, underwriting, and distribution. Origination is basically producing the shares and selling them. Underwriting is like an insurance policy where you say, yes, we've got $1,020 shares that we're going to sell into the market, and I guarantee you that that will return to you at least $15 million, $18 million, what have you. And so kind of like it's a form of guarantee. And usually the investment banker will say, yes, you're going to be releasing $20 million worth of shares. I'll be willing to guarantee you get $18 million from it. And by the way, I expect $20 million worth of, not 20 million, what's the gap there? $2 million worth of whatever out of the company to pay for my insurance premium, if you like. So the banker, the investment bank, will guarantee that you're going to raise a certain amount of capital, but they will also charge you. So it's just a form of insurance. Okay. So we've done origination, we've done underwriting, and then distribution. Distribution is the practical job of actually administering the actual breakup, the production and dissemination of the shares, and their skills at doing that. Remember, the venture capitalist is not really that interested in a public company, so they're wanting to get out of that. Their skills and their risk profile suits that young, high-risk venture. They're not expert necessarily in distributing shares to the community. They might be, but most probably they don't. They tend to leave this to another party, which again sort of like fits into this little club of groups. You've got the seed capitalists, you've got the venture capitalists, now we're talking about the investment bankers. To a certain extent, each one of those is likely to have a different level of profit and a different level of risk. Origination. Origination really is the act of generating the shares. Just hang on for one moment. Sorry about that. Okay, in origination, it is really just the administration side of getting the practicalities ready to go. And really that's an important part, a vital part of the strategy involved in the initial placement offer, the IPO, initial public offering. Underwriting, I think we've talked about that. Important thing in this slide is that there are two types of underwriting. The main difference is that in a standby underwriting, the investment banker is actually standing by to guarantee a certain revenue from the IPO. And so they really are providing a kind of like an insurance policy. On the best effort basis, it's saying, yes, we're going to help you, we're going to do this, we're going to do that, we're going to originate the shares for you, we're going to market them, we're going to connect you to the investment world, all that sort of carry on. And well, it's going to make our best effort, and we expect a reward for making our best effort, but might work, may not. So it really leaves out the insurance part. You can read that in these slides. Makes no guarantee. It's the guarantee part here, which is really important. The insurance just doesn't exist. It means that it's kind of cheaper. And if you're confident that you don't need it, then best effort will be kind of workable. But for a lot of companies, they prefer the standby underwriting. So it has a considerable popularity. Okay, if the investment banker is taking the standby position, which means that even if 20 million shares come to market, and if the market only takes less than 20 million, then the investment bank is there standing by to buy up the remaining ones. And they'll be paying the new company, they'll be paying them a fee, or rather a amount of capital. They'll be sort of actually buying the shares physically, putting cash into the company's coffers. And it's important that because the investment bank is doing that, they get the pricing right. There's no point in me saying, you got 20 million shares at, I don't know, $20 each or whatever it is, $10 each, and or $1 each, and we're expecting you to earn a certain amount of money. The investment bank really earns its keep from being able to estimate fairly precisely what the community is likely to, how the community is likely to respond. So are they going to, is going to be 20 million buyers out there to buy shares at $20 or whatever, or is it only going to be 10? Getting the pricing worked out so that there's enough appetite in the community, so that you kind of discount it a bit to be able to get all of the shares be sold. But you don't want to underprice it, because if you underprice it, then the shares will be selling too cheaply and you won't be able to realize the capital you need, all sorts of unfortunate things. Okay, getting the pricing worked out is absolutely critical and key. In order to do that, the investment bank will perform what's called a due diligence. It's a lovely term. It's very, very popular, and most of you in your professional lives will be talking about due diligences all over the place. It simply means checking, doing your homework. It will be making sure that everything is as it appears, and so you've got the greatest confidence of moving forward to where you expect to be going. And you can read the rest of the slide there. I think we might take a break now. We're a bit past the hour, so we'll take a 10-minute break now, and then we'll come back. When we come back, we'll look a bit on calculations and sort of move through a bit of that. We're not going to do too much calculations here, but that's what we'll do after the break. So now it's 3:08. So at 3:18, we will return. I will pause the share. Okay. At this stage, we'll stop the video and I'll say goodbye to you, and we'll be back in 10 minutes time. Okay, and we'll share the screen. Wonderful. Okay, we've been introducing the idea of the investment banker and the whole notion of underwriting. Let's look at some examples of that just to get a bit of an idea of how this sort of shapes up in practice. We'll look at an example. Here we've got a company which is planning to sell 2 million shares at $20 each, and so they're expecting $40 million. Okay, and that's their goal. They want these shares to be sold into the market so that the eventual owners of the shares consider that they've got good value in terms of dividends for their $20 or whatever. The company would prefer to sell them for $20 because they expect a certain amount of dividend coming out to, if you like, entice the buyers. They could sell them for $10, in which case the eventual shareholders would think they're really sort of very fortunate because they're getting a really strong yield. Or they could maybe sell them for $30, in which case the shareholders would perhaps have some concerns that the company isn't making enough dividend to make the $30 price tag kind of worthwhile. But we're assuming it's $20. We're going to be coming back to this pricing question a little bit later. That's why I want you to just kind of be thinking about it now. Right? The company wants to get as many dollars as it can to buy the stuff that it needs to operate the company. The factories, the computers, the motor vehicles, telephones, whatever it's going to be. Okay. This is the risk. If they go to the market and they're only able to sell a fraction, we'll say 95%, in this case, they're only going to raise $38 million. Well, yeah, okay, that's $2 million shortfall. And the company really is looking forward to having $40 million to play with to buy assets and do the things the company needs to do. And this is where the underwriting comes in. We're going to look at this idea of what's going to happen to the unsold shares. You can read through that. Basically what we're saying is that the underwriter is guaranteeing and somehow making sure that the issuer, the company that's floating, that's coming onto the stock exchange, is actually going to get, a predictable amount of money. Like it operates like insurance, and like any insurance, it comes with a cost. Let's look at how that works. If we're looking at this company wants to sell its 2 million shares. It thinks that they're going to sell into the market at $20 each. It goes along to an investment banker and they say, Mr. Investment Banker, can you help us to sell these shares, please? And the investment banker says, yes, I'll underwrite those shares. I'll sell them and I'll guarantee them so long as I get a 7% payment, a premium, if you like an insurance premium, for the service of guaranteeing that you're going to get all of your 2 million shares sold. Let's look at how that works. We've got the original situation where we've got $2 million times 20, which is $40 million. But here, for every share that's sold, every $20 that's sold, 7% is going to go to the investment bank. So out of the $20, 7% of that means that for every share that is sold, the underwriting company takes their, we'll call it an insurance premium, out as their own revenue. We call that the underwriting spread. I guess it's a more polite term than insurance premium, but that's effectively what it is. Okay, what that means is that if there's $1.40 going to the investment bank, there's only $18.60 going to the company. And so if the company is intending to buy $20 worth of photocopying paper or what have you with that share, they'll only actually be able to buy $18.60 worth of it. Maybe they'll have to try a little bit harder to get it from some discount office supplier or something. But whatever it is, while they're selling what appears to be a $20 interest in the company itself only has $18.60 worth of equity to actually buy assets with. And so that can come back to bite them later on. We can work out the proceeds to the underwriter. So the underwriter's taking $1.40 out of each of the 2 million shares, so there's $2.8 million going to the underwriter. And what's left, which is $37.2 million, goes to the issuer, the company itself. Now, I can remember still, when I was probably your age and learning the stuff for the first time, I thought, that's really weird. In this example, we'll just go back a couple of slides. We were concerned about the company only getting $38 million when they really wanted $40 million. And so they've gone to the trouble of enlisting the help of an underwriter. Here, as we go through the worked example, we're saying that by using the underwriter, yes, sure enough, we've got our risks taken out, so that's fantastic. But we're actually only getting $37.2 million in actual revenue. Why do they do that? As I say, I've been playing with this stuff now for probably twice as long as most of you guys have been alive. I still don't quite understand the logic of it, but it's what's happened. I think the reality is that when it's being done in practice, the thing about it is the company goes in with a certainty and, if you like, an expectation, an explicit expectation. They're only expecting to get $37 million. In the first example, they were expecting to get 40. And it didn't happen, right? So there's this risk, this uncertainty. And so it's better to go in saying, I'm expecting to get $37.2 million and get it, than going in saying, I expect to get 40 and only end up with almost $3 million less. That's the kind of logic of it, as far as I can make out. So it's a risk mitigation scheme. Okay, then what happens? They still sell 95% of their shares, but they're using a standby arrangement for the underwriting. So what's going to happen there? The company is effectively earning $18.60 per share. The underwriter has sold 95% of the shares, and they're earning $1.40 each from them, so we can work out what that is. And then we'll have to get on to the next slide for that. Okay, so this, hang on, we'll just go back. One last point I need to make here is that while 95% of the shares have been sold to the public, in this situation, the underwriter takes, where is it? The $1.40 times 95%. Once again, the next one. So the underwriter takes the $1.40 times 95% of the 2 million, but then it goes and buys the remainder of the shares off the issuer. So the issuer has actually sold all 20 million shares. That's the trick with this. And so from the issuer's point of view, as the company's point of view, they have got their 20 million times, 2 million times $18.60. So they've definitely got $37.2 million. The underwriter earns 95% of 2 million times $1.40. So for every share of that's sold, which is 95% of 2 million, earns $1.40, so that equals 2.66. However, the underwriter then has to buy the 5% of the shares. So there's 5% of the shares, which is 100,000, and the underwriter has to pay the issuer the price that the issuer actually nets out of the deal. So the issuer was only expecting to get $18.60 out of each share that's sold. The underwriter comes along and says, you know, I'm going to buy the other 5% of your shares, and I'm going to pay you $18.60 for it. And so the underwriter has to then pay out $1.86 million. And so from the point of view of the underwriter has earned $2.66 million, but then they've spent $1.86 million, which means that their net earnings is $800,000, 0.8 of $1 million. That is where you'll find the textbook stops writing about the sad tale of the underwriter who has done all of this work and is a person of remarkably goodwill and intention and helpfulness and all the rest of it, and they've only come away with $800,000 out of this deal, which included almost $40 million, and they are therefore quite fine and wonderful people. What I invite you to just keep in mind here, when we do these calculations, and when you do them for things like the assignments and stuff, this is as far as it goes, right? What's the effective proceeds to the underwriter? $1.8 million. That is the answer, and that's the answer we'll be wanting in quizzes and anything else. However, I would like you to just maybe in brackets or on the side of your page if you're writing notes, notice that while the underwriter has paid the issuer for that 5% of the shares, so the issuer is happy, goes off, happy as a big mug, fantastic. The underwriter, the investment bank, actually is now the owner of those 100,000 shares. And if today we're able to sell 95% of them, or 1.9 million shares at $18.60, the fact that we didn't find buyers today at $18.60 still means an awful lot of shares were sort of going onto the market by people who are willing to pay $18.60. Why am I telling you this? Because the investment bank, the underwriter, has earned $2.6 million. They've experienced costs of $1.86 million. However, they're the happy owners of these unsold shares, 100,000 of them, which potentially could be sold into the market at $18.60 each once a few more buyers are sort of brought up. Maybe they might sort of lower them to, I don't know, $18 or $17.60, and then they'll be able to flick them all on. And so when you do these calculations, while it's sort of important, if you're doing them for the textbook, if you're doing it for quizzes and stuff, just get to the bottom of the slide where you say, yes, the poor old underwriter is only netting $0.8 million. But remember, they're sitting there with pretty close to another $1.86 million worth of shares. And so it means that their ultimate income by the time they do eventually sell those shares into the market is probably going to be far closer to the 2.66 than it is to the 0.8 as we finish the analysis. Okay, so it'll be just a little bit of a secret between you and I, but just remember that when you read this, and it is I find a little bit confusing in the textbook that you know what actually sort of happens here. So just watch out for that. There are other arrangements, by the way, as far as underwriting goes. Who has title to the remaining shares and that sort of thing. Okay, then we move to best effort underwriting. Best effort underwriting means that the underwriter, the investment bank, is simply going to make their best effort to go and sort of sell all shares. Using the same example, still got a 7% spread, and so the underwriter is still going to be earning the $1.40 per share that's sold. So out of the 95% that are sold, they'll be earning $1.40 on those. Out of the 95% that are sold, the issuer will be earning $18.60. And when we move down into what happens there, the underwriter comes away with a 2.66. They don't have to then buy up the remainder. So they're $2.66 million in front for the exercise, and the issuer earns the 35. Okay, obviously the best effort arrangement is more attractive for the underwriter, less attractive for the issuer, but that's just a matter of negotiation, which is pretty close to what finance descends to after we get past all of the theory and the fancy mathematics. Okay, I hope that sort of makes sense. I do recommend that you read the textbook. I'm always recommending that you read the textbook. The nice thing about if you've got the textbook is that you can actually sort of run along and think it over and sort of see the words that are laid there rather than trying to remember what I've been rabbiting on about. Okay. Now we're going to actually sort of unpack this a bit more, looking at it from the point of view of the costs involved. Because after all, from the company's point of view, they've been sort of going along with their venture capital sort of quite happy, and now they're sort of moving into the big world of being a public listed company and needs to look at what the cost is of running this IPO. In the example we're looking at, we were hoping for $40 million, but one way or another, the issuer has come away with somewhere between 35 point something and 37 point something million dollars. So there's been a cost, which, you know, is in the vicinity of $3, $4, $5 million. Okay. So we need to understand that and be able to calculate. It's not a hard calculation to do, especially once we see the components in it. Okay, 3 basic costs associated with issuing a share in an IPO. The underwriting spread, well, we've already seen that in our examples, so that should be pretty obvious. The next cost doesn't have to do with the underwriter. It really has to do with the whole business of going public. And that means you're going to have legal people, finance people, and the government all looking over your shoulder, giving advice, formulating the administrative side of it, and making sure that you pass muster with the regulators and the fees and so on that are associated with that. So the out-of-pocket expenses tend to be considered almost as a fix. They're not proportional to the number of shares that you issue, just that once you've decided on a particular IPO, like the scale of it and the value of the shares and so on, then the out-of-pocket expenses tend to come in as a constant. And the last one is a bit tricky, and this is what we're going to be moving on to. We're going to take a few slides to get to it. And this is the question of underpricing. Underpricing is where you give a discount on the first day of trading simply to get the shares sold. And by the time underpricing is combined with the whole underwriting kind of process, you see that the poor old issuing company actually has fairly significant costs involved, right? Because they're going to be losing money to the underwriting spread, but as well as that, if what they're going to sell into the market at $20 is really worth, let's be absurd, $30, then it means that for every share, the company could have earned $30 and they've only earned $20 because they've underpriced the share. It's helpful, or I find it's helpful when you're kind of trying to conceptualize this, to think of the way that notionally, if you own, I don't know, $1,000 worth of shares in a company, notionally, you should own $1,000 worth of the assets in the company if the shares are correctly priced. In this little example we've done so far, we're going to be issuing what appears to be $40 million worth of shares, but the company has only got 35 point something, 37 point something million worth of dollars to actually spend on buying stuff. And so if, you know, the day after the IPO, all of the shareholders all get together and they say, oh, I think we'll sort of just, you know, take our money and run, they'll only be able to find in the company $37 million, where there's actually people with shares saying they own a total of 40,000. You see the problem there? So underwriting is a problem for the company. If nothing else, it simply limits the company's capacity to make money. You know, if you need a certain number of machines, of a certain scale of factory, a certain number of motor vehicles, a certain number of computers, whatever it is that you need to get your business to run, and that tallies up to $40 million, but you've only got 35 point something million dollars in your bank account, you're not going to be able to run the company at that level. And so it makes it harder for the company. So underpricing is a major problem, but it's also endemic. Okay, how's it come about? We're talking about the first issue of shares, the initial public offering, the initial offering of the shares for, you know, sale to public people, you know, public investors. Okay. The easiest way to sell things is to sell them at a discount. You know, if you can go to one supermarket and buy milk at, I don't know, $1 a litre, and you go to some other supermarket and you get it for 90 cents, there's going to be a lot of milk going bad in the supermarket that's trying to sell it for $1. It's easier to sell things at a discount. And so to actually sell the shares into the market, if for every dollar of assets in the company, it's represented, it only costs the investor 80 cents to buy it or 90 cents to buy it, then the investor is going to say, hey, this is a fantastic idea. I'm going to pay 80 or 90 cents for an investment which is going to return me what I consider to be a fair return on $1 investment. He's going to see that. So there's a bit of a tussle. In some ways, the value is kind of explicit. It's determined by the dividends of the company. It's explicit. It's hard. It's objective. It's dependent on the amount of capital that the company has to play with. The issuer wants the share price to most accurately reflect the value in the company. If the value of the shares is low, then what it means is that the investor is, you know, paying 80 cents for $1 worth of assets, basically. So the issuer really would prefer it to be as close as possible to $1 for every $1 worth of assets in the company. And as the shares get lower and lower, then what that's really saying is that the underwriter simply just doesn't have the capital resources that it really should. Now, this is a problem that only happens in the primary market when you're selling from the company direct to the community. Once the share is being swapped about in the secondary market, you know, from one shareholder selling their interest to another shareholder, the company actually doesn't see what's happening with our $20 shares. The $20 share could be sold from you to me at $20 or $30 or $10. That doesn't make any difference at all to the company. The company doesn't end up with $1 more in its pocket as a result of you selling me your share for $100. No difference at all. But from the point of view of the company, if the share is trading in the secondary market at $100, then the company knows that there's going to be pressure on them to produce a dividend which would be appropriate for $100 worth of share, even though you've only got $20 worth of assets to produce it with. Okay, underpricing is defined as the offering of new securities at sale which is below their true value. That should be obvious. In a standby offering, the underwriters will suffer a financial loss if the offer price is set too high, simply because if the share price, the offer price is set too high, fewer of them will get sold, and those that are left unsold, the underwriter is going to have to pay this higher price for. And so, in fact, the poor old underwriter ends up worse off for two different reasons. It's going to have to buy more of the shares from the issuer, and it's going to have to buy them at a higher price because the price has been set initially at a unachievable level, which just sort of makes it very difficult. Makes it very important why the underwriter has to get the price right. It's the most important job for the underwriter. Okay. You can read the rest of this slide. I think it should make a nice amount of sense. The last point I think is kind of interesting. From the investment banker's point of view, there's an advantage in underpricing. The investment bank doesn't really care directly what happens to the company if they end up with, more financial obligations to their shareholders than they've got finances to be able to meet them. Doesn't really mind about that. But it does mind about having unsold shares or shares that have been priced too high, because then it gets very, very expensive for the underwriter. So the underwriter would prefer to undervalue the shares, because then it can be far more confident that the shares are all going to get sold up. And even if they're not sold up, the underwriting cost is going to be less significant to the bank, because each share they have to buy off the issuer tends to be priced lower. Okay. The downside is that if you're thinking about which investment banker to use, if word gets about that such and such an investment banker always badly underprices the shares in new offerings, then as a venture capitalist, you're not going to go there. And so the investment bank will suffer a loss of reputation because they're basically undersold, other people's businesses. And if they've undersold other people's businesses, when it comes to your turn, you can be sort of expecting the same treatment. Okay, but underpricing is a very real phenomenon. Here we've got a lovely little table, that looks at the way that underpricing works in different companies. The average first day level of underpricing varies by company, but in Australia, at least in the period that was being considered, on the first day, the shares went onto the market at something like 23% on average below their real price. So for every dollar of shares that the issuer was able to sell into the market, every dollar only turned up about, what was that, sort of roughly 77 cents. Is that quite significant? Other companies, I would say probably more by coincidence than intent, have had numbers above and below. You'll notice that numbers in the teens, 10, 15, that sort of stuff, 17. There's a few of those in different companies. You see that sort of some companies like Greece, for instance, if you're doing an IPO in Greece, it's likely that the starting price is going to be something like 58% on average underpriced, which is pretty huge. So what that means is in Greece, for every dollar of shares issued, there's only 41, 42 cents of equity. They're like real assets in the company. Okay. Japan's also not very good in that regard. Anyway, there's quite a range. So I just find that an interesting slide, because there's not something which is unique to Australia or unique to this textbook or what have you. There's something which is shall we say, a global problem. The other thing which is curious is that the shares, once they're sold, will often appreciate through the day. And so the companies will be offered, or the shares, the IPO, the initial offering will be offered first thing in the morning when the share market opens. A lot of people go in and buy. But by the afternoon, not uncommon for the shares then to be being on-sold and be earning higher prices. And that's a curious sort of phenomenon. I'll let you read through this example. Okay, I'll leave you to come back to that one. I'll work through this example here. Let's look at a company that plans 114 million IPO with an offer price of $5.10 per share, underwritten at $4.30. So the spread there is the spread between $4.30 and $5.10, which is 80 cents. Company's legal fees, asset registration, and other administrative costs is $525,000, almost $500,000. And the company's share price increases 14% on the first day. Right. What this is saying is that as it was offered, there was 14% immediate growth because the community, the shareholders, recognised that the shares were really worth more than the $5.10 that they were being sold for. So you've got three numbers there. You've got $4.30, which is the underwritten price, which realistically is what the company earns. Then you've got the $5.10, which is its nominal starting price. But then you've got above the $5.10, 14% above the $5.10, is the actual price that the shares settled down with really within 24 hours, once they got onto the secondary market. Very common. Okay, let's look at the underwriting spread. We've got 80 cents. We've seen that already. We've got an idea of what that means. And so out of the 22 million shares, 80 cents ends up with about $17.88 million worth of underwriting spread. So that's $17.88 million that goes to the underwriter, the investment banker. We've had the $525,000 as the data, the asset fees, the legals, and so on. But then we've got the underpricing cost. Okay, to get the price that the shares were trading up by the end of the day, end of the first day, we can take $5.10 and multiply them by 1 plus the growth, which is 1 plus 14, 1 plus 14%. And that will give us the price that they're trading for at the end of the first day, which is closer to its stable, likely price. And so simply by putting your money up first thing in the morning, by the afternoon, you would earn something like a 14% return. Now, when you think about that, and especially what I was saying earlier, that regular companies on the stock exchange are typically earning between about aiming to earn around 6 or 8%, typically on the 6 end, sometimes smaller. To make 14% in a day is a lot better than waiting a whole 12 months to earn 6 or 8%. And you can see that there's an incentive here to be a bit of a gambler on these first day of offering. Okay, we can work out what the underpricing was. Basically 14% of $5.10. By the way you work it out, it's 71 cents. And so if we look at the 71 cents multiplied by the number of shares that were sold, we've got $15.87 million worth of underpricing cost. And so from the company's point of view, they have sold how many? They have, this is the right one. Okay, they've sold, the company has sold 22.35 million shares. And for each one of those shares, they've lost 71 cents because those shares appear in the shareholders' eventual eyes as being worth $5.81. The company has lost $17.8 million as a fee to the underwriter, because remember the company is only earning $4.30, not $5.10 for each share that they sell. So that's $17.8 million. The company also has $500,000 of administrative costs, the ASIC and legal fees. And finally, the company has lost $15.8 million as a result of selling the shares into the market at a discount, at a price below what is actually a sound price for them. And so all up, the company is worse off effectively, certainly in its relationship with its shareholders, to the tune of about $34 million. Now, $34 million is a pretty substantial chunk of the $114 million that was seeking to be raised, right? They're looking to raise $114 million. They're doing that on the basis of $5.10. And so they've got these various costs. We've got the spread, out of pocket's not so important, and then the underpricing, price. So all up, $34 million is a lot of money, especially even when you're considering it in comparison with 114. Something like still in the area of almost a third you've lost. Now, who gets the benefit from the underpricing? Well, that's really the shareholders, isn't it? They've bought shares for considerably less than their real worth. So it's not as though the underwriter gets it. The underwriter gets this 17, but the issuer actually has to face up to losing all of those. And so it's going to be a situation where for every dollar of assets the company owns is really being covered by the best part of $2 of $2, the correct number there, close to that, of share price, like the stockholder value. Okay, I'll let you work through this other example yourself. It's kind of useful where the slides have more than one example. I'll work through one, and you guys can sort of follow that, but then I recommend that you go through and do the maths yourself. If you like, by the way, post up your results onto the news, onto the general forum. Right? The Q&A is for asking questions of each other, or maybe asking questions of me. The news is the forum that I use to basically send messages out to everyone. But the general forum is where I'd really like you to be posting your answers to these other worked examples and things that we're not working through. Okay. Let's look at other capital raising schemes. And there are a couple of those that we want to be looking at. If a company, a public company, has a high credit rating, and this is typically not a new company, then the easiest way and the cheapest way of getting external funds is simply to make an open public offer. That simply means that they tell the world, maybe an advertisement in the financial sections of the Fin Review or the Australian or somewhere, and they say, we're going to be selling a whole lot more shares. And of course, people know the company. If BHP was to do this, or Commonwealth Bank, or NAB or something, there'd be a whole lot of people sort of beating on their doors to go and buy some. And so this is what a respected public company can expect to get away with. Also known as a seasoned public offering. And the reason is that it's a public offering from a seasoned company, a company which is mature, well-known, reliable. Okay. Similar thing for an IPO. Okay, a open offer from a company is cheaper because the seasoned nature of the company means that there are lower risks, and so the company can be more efficient in how it actually gets its capital from the community. Okay, so you've got the general public offerings, which tends to be restricted to mature companies, seasoned companies. There are other ways of raising capital as well. There's private markets. Private market is where you go along to some individual or entity, something a bit like going along to a venture capitalist, where you go for a private placement. And a private placement, different to a public offering, because what you're doing is you're going along with some company. You might be starting some company, it might be a chain of pizza shops or something. And rather than simply selling them into the general market, what you do is you go along to the AMP Society. And you go along to AMP and say, oh, we know that you're a big investor and we're just about to float all these extra shares. Would you like to buy them all? Now, the advantage there is that because you're just going along to a single company, and if they come on board with it, it takes an awful lot less marketing than going along to the general public. And so a private offering is something that works, especially when you've got something of value or is perceived as something of value to your financing target. I'll let you read the rest of that slide. Many private companies of high credit quality prefer to sell securities in private markets, even though they can access the public markets. True. Okay. There is less regulatory costs involved in working in private markets because you're simply not going to the world in general. If you go along with your information to AMP and sit down, you're going to be able to field the questions and kind of inform them of reality of what's going on far more effectively than if you try and do that to the community in general, where you're trying to influence some people out of the 20 million or whatever it is in Australia. To actually do it, you're only having to communicate with one person. So you don't have the same need for transparency, even though you expect the communication to be both honest and comprehensive. It's not as though it actually has to be built that way and proven to be that way. And often these things are done through an informal network. Companies that regularly deal with other companies or regularly deal in a particular sector of the community, something like that. And part of this makes sense of this last point, that there's a preference for working with small number of sophisticated investors. In other words, investors who know what's going on, investors who are perhaps willing to invest in the kind of risk profile that you're presenting, things like that. Okay, private placements, talked about those, so you can just read through that slide. Private placements, yeah. Just read through these slides. Main advantages and disadvantages of private placements is that a private placement, if you go along to AMP Society, for instance, and you want to sell this new offering, which might be increasing your ordinary shares by, let's say, 20%, what you're doing is putting into one set of hands the equivalent of 20% of the value of your business, which is 20% of the influence on the control of the business. What happens if that 20% gets into the hands of somebody who wants to do something with your company that you don't want to? They could even, for instance, be of the opinion that it'd be a nice idea if they were to completely rebadge your company or do something else which you may not be very comfortable with. The control becomes an important element there. So private placements kind of risk upsetting the balance of control which exists in the company. And as a result of that, ASIC has put in a limit which restricts the private placements to 15% of the number of existing shares, unless all of the shareholders are happy. And that's sort of means they have to be taken back to an annual general meeting and so on. And you can read the rest of the details there. That's simply the rules that we live by. And it's kind of meant to just keep the whole show a bit fairer. There are also companies that specialize in taking parcels of shares. They kind of have a certain parallel with venture capitalists. Private equity companies, holding companies, they are companies that are kind of operating as an intermediary between other investors, and then they will then hold investments for their parent investors. I hope that first point makes sense there. Private equity companies invest in more mature companies, and they often purchase 100% of the business. Now, by the time you purchase 100% of a business, what it really means is that business has become a subsidiary of the larger owner. And we live in a time when this tendency towards companies all being predominantly owned by other companies has become quite endemic. You don't have to own the every share in the shop, because you'll find that in practice different people have different ideas about the where we're going there. And let's move on. The private equity companies are going to be looking at basically increasing the value of the companies they acquire, with a view often to either increasing their own bottom line or eventually to sell them on. And that's where the private equity companies sometimes look like a form of second stage venture capital. They're looking to rev up the company to move it on. I had experience with a situation like this a few years ago when I was involved in a software company that designed investment analysis tools for the property industry. And that was an interesting job, and I met one of the directors of our largest competitor. And it turned out that this chap was in he'd set up, his strategy was to buy small software companies that were producing financial appraisal software, and then basically package them all together, put them into a larger public company. So eventually you'd be able to sell the whole public company, made up of all these little companies, off to somewhere else. Now, it was a very clever strategy. It wasn't involved with IPOs, but it was absorbing smaller companies, basically putting it into one large entity, particularly with the intention of selling it off for a profit. I think he wanted to retire by the time he was 35, and he probably has done that by now. Okay, so private equity companies, the last point here is that they only hold them for a relatively short time. Okay. A lot of this funding is really about juggling risk and return, and changing the character of the company, growing it, making it more reliable, reducing its riskiness while maintaining a particular level of dividend, of output, if you like. And that means that as the company becomes more established, then the way that it accesses funds, it'll access funds and investment from different sources. Let's just look at how that goes. The sources of funding progressively are those that are comfortable with lower returns because they see less risk. That's why the venture capitalist will sell on to the open market, perhaps to a private equity company. Then the private equity company will then take that next step and still with a short-term interest, really working on the capital gain in the value of the company. Okay, let you read through those. I think that's all pretty straightforward. You can just read through that. This is important, and this pretty much kind of takes us out. We haven't talked at all about bank funding yet. We've been talking about, well, the only time we're talking about banks was investment banks. Investment banks are not really banks in the normal sense. The debt side of the balance sheet, or part of the balance sheet, normally sort of comes from banks, or at least a fair bit of it. And it's important to look at the way that companies use bank debt as a source of funds. And the two that are important are business overdraft and then also a term loan. These are not debentures, but they have a lot in parallel, or a lot in common. Certainly a term loan has a lot in common with debentures. The pricing and the way that they're kind of described is different, but they're still relatively short-term debt instruments that are made with the intention of basically turning them over. So a term loan will be turned over somewhere, well, in the medium term, 3, 5, 10 years, something like that. But the company doesn't intend actually paying it back. What will happen is that when the term loan expires, they will simply pay out this term loan with another 5 years of term loan. The advantage from the bank's point of view is that by having the term, the bank has got a certainty with where the money is going, and they have their risk under control, because it's not as though they're lending to the company with the obligation to leave it there forever. And so term loans have got this nice medium-term kind of character. Business overdraft is a little bit different. It acts very flexibly, almost like a credit card, only on a bigger scale. And it tends to be matched, it tends to be used for the company's working capital needs. And it's only intended to be short-term, very short-term borrowing. Now you find that a lot of companies tend to rely on their overdraft and have like a perennial overdraft, especially smaller companies you see this, but even larger companies will have some sort of overdraft. It just simply gives the company very flexible access to debt. One of the curiosities of overdraft is that at least notionally, they are at-call loans, which means they don't have any term. The bank could conceivably contact the business and say, we would like your overdraft paid back, please, in 24 hours. And there was a time when it was common for overdrafts to be expected to always come back to zero at least once a year. And the idea was that if you got your overdraft at the right level compared to your term loans should be taking care of your long-term borrowing needs, and your overdraft is meant to be only taking care of your short-term needs. So if it's only short-term, it means that certain times of the year, you know, maybe in the middle of summer, if you're operating a company that sells pool salt or something, you should be working really well. But by the time you get into the winter months where the sales might be a bit slow and who knows what else is happening, then you might be really relying on your overdraft to pay the wages and keep the show kind of going. So these two loans is worth being familiar with. Not a lot more to it than that, but just being aware that the banks have this longer term lending or borrowing and that is sort of rolled over regularly, but then also the shorter term, which is the bank overdraft. You hear a lot about people operating on their overdrafts. Okay, I think I'll let you read through those. It's a good idea to go and have a look at the Australian Australian Stock Exchange. See what's there. And just as a general issue, as we're talking about companies, especially in these modules, spend a little bit of time just looking at things like the ASX. Look at the information which is available from the ASX, their data, annual reports, their intelligence on individual companies, just the commentary which is written. It's really useful to like put background into this, because right now I'm telling you stuff that could have been written in a textbook 100 years ago. You'll read a textbook and that's been written a few years ago, right? Connecting it to the real world, especially the corporate finance stuff, is really where reading the Fin Review and going on to things like the ASX is really, really useful. Okay, with that, I think we will finish up for the day. Yeah, look through those and just, as I say, use those as seed questions, if you like, that hopefully will just pique your interest. Okay, thank you very much for your attention. I've had a couple of questions about the next assignment. Next assignment is Moodle. It consists of 15 questions, and some people will be very pleased to know that they're all going to be multiple choice questions, even the numeric ones. So it'll be a little bit different. However, look at the details in Moodle on exactly when it becomes available and how long, because you'll have to have done your work, if you like, go in having done your revision so that you're up to speed with it, because you don't have as much time as we had for the first assignment. So just have a look at that. But multiple choice, 15 questions, you're in and you're out. That's good. And when that does come up, which is now getting fairly close, I wish you every success with it. Yeah, stay tuned. Okay, thank you very much, and I'll see you next week.
All right, thank you, sir. See ya.
Thanks, Ian. Bye-bye.
Bye.